Well, hello everyone. Welcome to Trading a Smaller Account. It is Friday, so happy Friday. Today is going to be an epic class. We are talking about verticals today. And the market is like bullish, so we're going to talk about long call verticals and short call vertical or short put verticals. And the reason that I picked this topic today is because we had a bunch of trades hit targets and they were largely long call verticals and short put verticals. We're going to look at a couple of new example trades, but one of the comments that came in a recent survey was that someone said that they were so concerned about what happened, what might happen if their short strike was exercised, that they don't have the confidence to trade verticals of any type in their long accounts, in their live accounts. And so I wanted to address what can happen because I think that having a complete understanding leads to confidence and competence to actually take what you're learning and potentially apply it in the real world if it meets your goals and trading plans for your account and all of that. So that is going to be our focus today. I want to thank all of you who show up here bright and early every Monday and Friday to link arms with us in trading a smaller account. So hello to Life in the Fast Lane and Rojo and Kay and Frank and Cecil and KH and Dominique and JV and Will and the rest of the gang. Thank you all for being here. If you are not following us in the land of X, we've got Rachel with us in the chat today, Rachel Deshelle, her handle at Rachel-CS, and mine is at Barb Armstrong CS. You can now also find us on LinkedIn. So wander over there and follow us on LinkedIn as well. So before we get into, the thick of things, just know that options carry a high level of risk and aren't suitable for all investors. Also know that we are going to use the Paper Money software application on the Thinkorswim desktop platform to do our example trades and review our example trades. Here's this important note that in paper money, short options will never be assigned early, but we know that they can be. Now, I have had short puts assigned on short put vertical trades, but I have never actually, I think, had the experience that I can recall of having a short strike on a long call vertical called out, but that is a possibility also. So if you are brand new to this group, please feel free to type a greeting into the chat. We started this year with $25,000. We're not at $500,000, but we'll come over to our trading a smaller account. Our max risk per trade is $500. Whether it's a long call vertical or a short put vertical, we might go as high as 550, but we're not going to do 600. So that's our position sizing for these verticals. I don't do a big in-depth market overview in this class anymore because Kevin Horner does such a fantastic job 4 days a week with his Trader Talks. If you weren't there this morning, you missed out. It's at the market open, 9:30 Eastern, so join that. But if we come and we look at the SPX, it's hitting a new all-time high today. So it's pretty hard to characterize the market as anything other than bullish. When we look at the NASDAQ, more of the same, hitting a new all-time high today. What about the Russell? Well, it hit a new all-time high on Wednesday. We have a bullish Harami pattern setting up. Some might argue that's a bit of a bull flag pattern setting up, but looking pretty bullish there too. And what about the Dow? Well, it's not, it hasn't come and knocked off this all-time high set on February 10th, but it's getting pretty close. Like that all-time high was 505 and we're at 496 right now. Some might call that a bit of a, if you're stepping back and looking at it, a bit of a bull flag and a stiff wind. But overall pretty bullish in the markets. And then if we look at our volatility index, we're now down at 17. Like it was just, at the end of March, we were up here around 30. So, this is indicating a fair degree of confidence, right? Right. Okay. So when we look at what can happen with a vertical. So let's come and look at a couple of vertical trades that we placed. And we did one on Lam Research. And so with Lam, we did a long call vertical, as we can see here, with the 270 and the 275 strike. And so if we wanted to duplicate this line, and I'm going to edit it, and we're going to get rid of all this. And this was our 270 strike. So what we wanted to have happen, the goal here when we placed this trade on this day, so, it had gapped up and kind of gone sideways and was moving to the upside. And so the expectation was that it would go through both strikes and stay there. And so when we do a long vertical, if you're new to this trade, and this is, an intermediate level class, so I don't usually review these, but with a long call vertical, we want something to travel above and stay there. Well, what if on this day we were called out? What if we had been called out? Now we have $31,000 in this account. We have only 14,000 available to trade. And I think that we did two contracts. So if our two contracts were assigned, the short strike, which is the 275 strike, we've now bought 55,000, or sorry, we've now sold $55,000 worth of stock we don't own. And so some people might be going like, oh, my landlord, like, what am I going to do? And so if we look at this and we say, okay, what would happen? Well, what we're going to do is we're going to go in because we bought the 270 strike, and we're going to buy $54,000 worth of stock. Okay. To meet our obligation to sell. So we're going to buy the stock at 270 to meet our obligation to sell it at 275. And you might say, but I don't have 54,000 in this account. Well, I talked to the margin team at Schwab, and they said they would allow you to exercise that right to buy. So we would just come in, we'd have a long call left on our account, and we'd exercise our right. When we buy a call, it gives us the right to buy the stock at 270. When we sell a call, we're saying, hey, if you'd like to come and buy this stock from us at 275 at any time between now and expiration, you're welcome to do that. And so if somebody took us up on that offer, because now it's trading at, 295 or whatever, and we said, we're willing to sell it to you at 275, if they took us up on that, and we create this short position, we fix it by going in and exercising the long position. And so is this a cause to freak out? No, because like when we place this trade, and so now let's go in and look at the trade we placed. So when we come to the monitor tab, we're going to come over to the account statement. We're going to look at LRCX. So on the 24th of April, we bought this 270 to 275 call. We paid 235 for it. And we put in an order and we said, hey, we'd like to sell it when it gets to 375, which would give us about a 50% return on our risk. And that was our goal. But what's our max gain? Our max gain would be if we got paid $5, right? And we got in this for 235. So our max gain then would be over 100%. And we said, like, we're not trying to be greedy, and we put this order in at 255. So we actually made more than 50% on this. We made almost a 60% return on this, getting out at 375. But, we were doing this live in the market, and we may have got a bit of a paper money fill, but we were happy to get out at 375. if somebody exercised the short strike and we then went in and exercised it and you know, so all of a sudden we've sold stock we don't have, we're making way more than we were even gunning for. So this is, you know, this is not bad news. This is like, wow, we just made like double what we were aiming for. Because, you know, our goal on this was to make about $1.25, and now we've made, you know, 2.50. In fact, in this case, we've made 2.65 a share or $265 a contract when our goal was to make a 50% return. Okay. And so this is not a bad thing. So how do we figure out, you know, in this case, what did we make on this? Well, it got filled at 235. We got out for 375. So in this case, we're going to just take this and subtract this. So we made $1.40 a share. And how many contracts did we do? We did 2. And I'm not, you know, taking our transaction fees into the discussion. So it's actually times 200 because we did 2 contracts. So we made 280. Now our goal in this class, our first goal was to make $100 a week. We've upped it to an average of $200 a week over the year, because if we started with 25 and we're now in this hypothetical account over 30, we've made our 100 a week. And this is paper money. So, you know, paper money fills, and we don't have to worry about hope and fear and all those pesky emotions. You know, there are no assignment fees. There aren't assignment fees, just so you know. There used to be, there aren't anymore. So, and then what's our return on our risk? Well, if we made $1.40, our return on risk is going to be $1.40 a share divided by that 235 is, you know, what we paid to get in, and we could have lost the whole thing. And so that turned out to be 59%. Okay. So like, we're happy campers. You know, that's a base hit. Okay. So if somebody, you know, exercised their right on the short strike, you know, on a long call vertical, typically with, you know, the example trading plan we're using, that's going to be a hallelujah moment. The thing is, you have to be aware, or I can guarantee you'll get a call, you'll get your phone ringing saying, excuse me, you'll have this situation in your account where you're short stock and you don't have approval to, you know, short stock or whatever it may be. Okay, now what about the put side of this? Because on the same day, because we were going to compare and contrast, we did a short put vertical. And how did that work out? Well, on this one, on the short side, and let's just go through this while we're here, you know, we sold it for 70 cents. How much were we risking? Well, we had a 250 wide strike here. So our risk on this is 250 a share minus the 70 cents. Okay. So our risk on that, let me just find the other one, is $1.30. Okay. And so how much did we make? Well, we got closed out for 3 cents. Now we put in an order to get closed out at 14 cents. Like, we put in an order to get to exit when we've got 80% of our max gain. So we got more than that. Again, that may have been a paper money fill. Like, in other words, if you had done this trade in your live account, you might have gotten out closer to 14 than 3 cents, but we got out at the market open when the stock had gapped up, and we'll look at that in a minute. How much could we have lost? Well, we could have lost $1.30 a contract. Okay, so that's what we were risking. And so our return on this one was over 50%. And for a short put vertical, that's pretty unusual to, you know, with the way we work our trading plan to get that higher return. But that was our return on risk on this short vertical. And on this one, we did 3 contracts. So if we take 67 times 3, on this one, we made $201. And you might say, well, we made more, on the other one. We made 280 on the other one. So therefore, that's the better trade. And we had a higher return on risk. So, like, why would I do a short put vertical when I could do a long call vertical? And this is another question that's come up in the surveys. So, like, why do you place one type of trade versus the other? And with this one, we looked at this on this because we placed both of these the same day. And we said, well, this was an old support level. If we could come down to here and still get a reasonable credit, and because volatility was higher, we were able to get a reasonable credit. And we said, as long as it stays above 250, so it could have gone sideways, and on the short vertical, we would have had a profitable trade. Where with the long call vertical, it had to go up above both strikes and stay there. And that's only happened, well, it happened briefly on Tuesday, but we didn't end up exiting this until Wednesday. Yeah. 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 So somebody's saying if you don't have the money in your account, there will be fees for margin. And that you may want to look into that. But if they have an annual rate on that, one might, it's going to be a nominal amount because you're only going to need it for, a few hours if you're checking these trades daily or maybe overnight. So it's going to be a very small amount, but you're right. Okay, so on this one, when we look at this, this is why. Now, with a short put vertical, if you're newer to this strategy, just, and I appreciate the patience of those for whom this is, an old standard. But if we look at this, when we do a short put vertical, we're going to sell a put. And what does it mean when we sell a put? We're saying, hey, if you'd like me to buy shares of this stock at 250, happy to do that. But if it stays above 250, why would somebody want to make you buy it at 250 when they could sell it for 268 or right now for 292? So chances are they're not going to exercise their right to sell it to you at 250. And just in case you're wrong, you're going to go in and buy a put, because what if the stock, some bad news came out and all of a sudden it dropped to 160 and somebody's saying, well, you told me you'd pay me 250, so here you go. Well, so by buying a put, it gives you the right to sell it. And in our case, we said we want to be able to sell it at 247.50. So if the stock was put to us, and we did 3 contracts, remember? So all of a sudden we own $75,000 worth of LAM, in a $30,000 account. What we're going to do as soon as we see that is we're going to exercise our right to sell it at 247.50. So now we've locked in our max loss. And what was our max loss? Well, it's the difference between the strikes, or 250, minus that 70 cents that I think it was 70. Yeah, 70 that we got paid. So we've now, locked in our max loss of $130 a contract times 3 contracts. So now we've lost $390. And so while you might be going like, well, that sucked. Yes, it did. But did you blow up your account? No, because how much can we risk? We said we're willing to risk $500 per trade. And, so have we blown up our account, even though we were assigned on the short put and the stock was put to us? No, this is a flesh wound, but we haven't amputated a limb. Even though this trade went horribly against us. And to kind of blow your mind, I would still say that this was a successful trade. even though we took our max loss. And you may say, like, Barbara's just taken 2 days off. Like, was she carrying too much mulch, having too much fun? Has she had a concussion? No. Well, if it's $1.80, yes, you're right. It's $1.80. Sorry, guys, my math skills are limited. 250 minus 70. So 250 minus 70. So I have been on vacation. $1.80. Okay. So let's correct that number. 180 times 3. And I'm not going to trust my 540. So did we blow up our account? No. And why am I saying that this is still a successful trade? Because we followed our rules. We followed our position sizing rules. And we also, knew what to do when, bad news struck. Okay. So yes, Ginger Bear, thanks for correcting me, and it's okay. I love some of these handles. And RG was in there and Billibury. So yeah. So, and then like to add insult to injury, we also would have had some transaction fees on this. But like I said, this is a flesh wound. And one of the challenges can be, and in the first 2 months of the year, we had a lot of successes early in the year. And one of the challenges when you have 6, 8, 10, 15 trades in a row go right is there's this temptation sometimes to not position size appropriately. Okay, so these were 2 trades that we did on lamb. They both went according to plan, but I wanted to go over what can happen if things don't go according to plan. And if you're not sure of how to exercise your right to sell, your shares, call the trade desk. Like that, they are there to help. But when you come to the monitor tab and your activities and positions, if this were, and it's not going to show up here because, if we're creating a closing order, it's going to assume you want to buy these back. But there will be a box here if this were just a long put that says exercise. And you can exercise your right to sell the shares. Okay. Okay. So we reviewed lamb. I now want to review CrowdStrike because we also did a long call vertical on CrowdStrike, and then we're going to place some new trades. So on CrowdStrike on the 27th, we bought a long call vertical at 495. We were out for 765. CrowdStrike. So we made 270, and feel free to check my math on that as well, because obviously I'm struggling on the math front today. So it's CrowdStrike we're looking at. So 270. And why did we do only one contract? Because we were risking $495 and we could have lost it all. And so our return on risk would be 270 divided by 495. Okay. And so that was a 54% return on our risk. And, if our goal was to, on average add, $200 a week to the kitty, well, that gave us a bit of a buffer, didn't it? And our goal was to be out prior to expiration and at 270 and at about a 50% return. And we got out for a little better than that. And sometimes, when we're putting in things live in the market, it gets filled at a different price. And so our target on this one, if you want to say, well, what was my target? Our target was 765. And when we put the order in, we put it in at 503, it got filled at 495. So that may be a bit of a a paper money fill, but it can happen in a live account as well. Now, I'm not going to do the math on these, but we also had a short put vertical on Dell. And we're out of that short put vertical as well. We got in for 95, out for 17. And so we did 3 contracts. Our net gain on that one was $234. And then we did a stock trade on Apple. And so if we look at Apple, we had just bought 18 shares. I think it was 18 shares because that's what we could afford to buy. We had a 5,000 position size, and we got out of that one on the 7th, this is the nice thing about putting in a target. So this was a swing trade, and and we bought it on the 20th of April. On this day here, when we had this diagonal resistance breakout. So we bought it on this day. Sorry. And then our target was this previous high in around here. So, when we come to the monitor tab and we look at Apple, and if you want to say on what basis did I do this trade? If you click on your note, the target was the previous high. And so our target on this was 288. And so the nice thing about this is it hit 288 and then pulled back below, but we were out. And you might say, well, that didn't work out well because look at how high it's gone. But we said we would be happy with that result if we got it. And, this was a return on investment of almost 6% if you do the math. Okay. Yeah. So somebody's asking if this is can be rewatched. Yes, it will be available in the archives by the end of the day. And so, if you want to see, where to see these, you're going to come to Trader Talks from Schwab Coaching on YouTube. And what I have up here are the trade management mini sessions. And if you scroll down, because we're talking about short put verticals today and long call verticals, and I just re-recorded and reposted this long call vertical trading plan. It had kind of aged out, and so I redid it. But this gives you a framework from which you can then create your own trading plan. Okay, but if we come to this, what you're first going to see when you come to the Trader Talks channel, and you'll want to hit subscribe in the bottom right corner if you haven't done that already. But when you come down here, what first comes up is whatever's currently being taught. And then if you come to playlists, you can scroll down and find the Trading a Smaller Account playlist. And then it goes from most recent on down. And then the trade management mini sessions, that's another playlist. That one's right here. And then here's Trading a Smaller Account. So if you want to see the class where we place those trades, you can just go back to, the 24th, okay, of April. And, Bob's your uncle. Easy to find. Okay, so that's the trades I wanted to review. Let's come now and look at Intel. Well, Intel, I'm going to do that one second. Let's look at ARM first. So ARM just came with earnings. And what you may want to do is look at the live news. Say, well, what are the analysts doing? Well, they raised their price target to, 202 from 191. TD Cowen raised their price target to 265. Barclays to 250. Recent high is 239. KeyBank raised their price target to 300. So ARM has, the analysts seem pretty bullish on it. It doesn't mean they're going to be right. But when we look at this, it came up. We had a bit of a bull flag came up, came down to like a similar low here. And today we have this bullish Harami pattern, which is a candlestick pattern that does not require confirmation. This is seen as a complete pattern. And so if we look at that and we said, well, what if we wanted to sell a short put vertical below this 212 level? Like, so could we come out here and say, come out 21 days? We come out 3 weeks. Now, what's the advantage of May 29th? Well, the advantage of May 29th is you're going to take advantage of time decay because it's going to happen at an accelerated rate. So that's appealing. And let's come down to 10 strikes here. And if I come to our Greeks and we look at theta, I'm losing, I'm losing on theta, at this, say, 210 strike, 23 cents a day. Okay, but if I come to, this is on the June, that's 40 days out. If we come to 3 weeks out, we're losing 33 cents a day instead of 23 cents. Like that's almost 50% more. And we want to take advantage of time decay. And so if we look at this and we said, okay, well, if I come out and I want to be below this 212 level, I can't sell the 212 because that isn't a choice, but I could sell the 210. And if we look at our example trading plan, it's like, well, is the stock bullish? Yes. Is the tech sector bullish? Yes. Is the market bullish? Yes. So check, check, check. Do we have an entry on the charts? Yes. If we look at, and let me come down here to my basics, do we have 20 times the contracts we want to trade? Well, we're at 110. Do we have a bid-ask spread that's under 10%? Check. So check, check, check. Does it trade more than 1 million shares a day? Then the next thing is the juice worth the squeeze? Can we get enough return? And our rule of thumb is if we're in it for 21 days, we want at least a 21% return. And so what are we risking here? And so if we come to our calculator and we say, okay, I'm risking $5 minus 230, so I'm risking 270. And to make 230, like that's a potential return of 85%. Like that's pretty rare. So when I look at this and I see that's, this is a very volatile stock, which means that these returns can be juicier. My first question would be is earnings coming up? But we just had earnings. And so if we have a degree of confidence here and say, you know what, I'm okay with these strikes and this level of risk. And how much am I risking? 270. So I could do, if I do 2 contracts, how much am I risking? Well, I'm risking 550. And we said, well, that's kind of at our upper limit. If we're okay with that, we're then going to right click, create an whoops. Let me do that again. I'm going to come down to single order, first trigger sequence, right click, create an opposite order. Say when we've got 80% of our max gain. Now you might say, well, I want to get out at 90%. Well, you can do whatever you want. It's your example trading plan. For this class, we've decided that we're going to exit when we've got 80% of our max gain. We'd like to take our risk off the table. And so the nice thing about May 29th is it's on the other side of the long weekend in May. So we get an extra day of time decay when the market is closed, because Saturday and Sunday, time decay is still working its charm, chipping away at the value of this option. And so, and that's what we want. And it's counterintuitive if you've come to the market as most of us did, with the idea of I want to buy a stock and I want it to go up in value. We're saying we're selling this strategy and we want it to go down in value. We want to sell it for more and buy it back for less. So confirm and send. Now, I also get asked a lot, well, we're going to compare this to a long call vertical. And we talked about this the other day, and we did some long call vertical trades and then some short put vertical trades. But we might say, well, here we'd rather do this as a short put vertical because it's been kind of consolidating. But with this, like this stock has really, since it broke out, it's really been uptrending with a significant amount of momentum, hasn't it? Like if we look at this, and so if we're expecting momentum, you might say, well, this is the one strategy I like to trade, and so this is why I'm trading it. But that's over 100%. It's moved to the upside. So if we're saying, well, we've got momentum on our side and we've got this bullish harami at a support level, could I do the 210 and the 215 and maybe, make a little cheddar? And, we could come out to June, but we've got lots of volume on these contracts. Now, the disadvantage of only going out 21 days is that, we have less time to recover if in fact the stock pulls back. But, all these other check here, bid-ask spread is acceptable, number of strikes is acceptable. So, could we come and buy a vertical? And is there enough room? Well, this isn't even at 250. At 250, we could make 100%. Like we could make more than 100%. And we've said we are not going to be greedy. If we can make 50%, we're going to be happy campers. So we're going to do 2 of these because we could lose the entire amount. So we're risking 470. And then we're going to compare these and say, okay, what's 233 times 1.5? So we're going to say if this is worth 350, I'd like to take my risk off the table. And you might say 350, you're leaving $150 a contract on the table. Yes, we are. And do we care? We've got a 50%. If we can make a 50% return in 21 days, is that not good enough? And we've decided that it is in this example trade. Now, you might say like, well, I want more. Well, then make your trading plan reflect that and then trade that for a while in paper money and see how that works out. So we're going to compare this again to the short put vertical. And the reason we consider a long call vertical on this one is because we have this momentum and it's bouncing off what we technically perceive to be a support level. So if we want to try and squeeze, are you guys cool with squeezing one more in? Or 2 more? We're going to move quick. Okay. So if we look at Intel, here's another one that's just gone ballistic and really moved up. It gapped up on earnings and then like paused for a hot minute, like 1 day pullback, 1 day pullback, 1 day pullback, 1 day pullback, hitting a new all-time high. And you might say, like, haven't we missed it? Well, we might have, but could we come back and say, well, our low here on this day was 109. And this is a stock that also might have higher volatility, you think? Like here it's at 90%. So if we came up 21 days and said, well, if we look at this, 109, like could we come in and sell something below that? The low on this was 109. So if we come out and say, okay, we're going to need 20 strikes here, that 21 days, we may not have enough volume. Because like these, well, and then again, we may. So if we look at the 110 and the 109, we've got 270 strikes. We've got an acceptable bid-ask spread, trades 73 million shares so far today. So we could we do this 109, 108, we get 40 cents, we're risking 60. So what if we did 109, 107? we'd get 77 cents. We're risking $2 minus 77 cents, which is 123. So 77 divided by 123, that's a potential return of 62%. And you might say, well, you're putting your stop. So if I were to draw a line, let's move this line. And we're to 109. You know, I'll get rid of this. We did this I was filling in for Cameron May. So are we okay with that? And if we're not, then we don't place the trade. But if we say, you know, this stock has momentum and we're okay with that, we're risking $1.23, so we could do 4 of these. How much are we risking? 492. So if we're okay with that, single order, first trigger sequence, what's our rule? We want to get out when we've got. Now, if this like gaps up on Monday and we have 50% of our max gain over the weekend, might we choose to take it? Absolutely. You know, it doesn't mean just because we put in a thing here saying we want to exit when it's worth about 15 cents, get 80% of our max gain, that we might not get out sooner. Yeah. Okay. So we're going to put that in our short put vertical bucket. And then I'm going to be super quick. And so I'm going to say, as we're putting this in, where's my short put vertical? Can't see for looking. And we're going to compare this to a long call vertical. So subscribe to the channel, my friends. Please hit like. Please follow Rachel and I in the land of X. And then if we come to the other side and we say, well, this has gone up a lot, but if we went out 3 weeks and thought, I think the market might continue to be bullish, could we do something that's already in the money, like the 115, 117? And so you know, because we're hitting an all-time high today, like, could we structure it so that if it just stays where it is, let alone goes up, we'd have a successful trade? So all this has to do is stay above 117 and it's already there. It hit 118.75. And so it's already through both strikes. It just has to stay there. And then what's our goal with a short vertical? Well, we don't want to risk more than 500. We could lose the entire amount. So we're risking almost $500 here. And then what's our target? Our target is to get out when we've got 50% of our max gain. So we're going to make this, I'm not even going to do the math. I'm going to say 148. That sounds like about, well, okay, 95 times 1.5, 142. So if it gets to 142, we want out. That's a 50% gain. We're leaving 58 cents on the table. Happy to do that. Thrilled to do that. Long call vertical. And we're going to compare it. Now, you know, if you were to trade this in your live account, would you do both trades? Maybe not. You might have a preference for one type of trade over another, or you might say, I'm just working on mastering short put verticals right now, so I'm only going to do like credit spread type trades. You know, and so, you know, this is you know, up to the individual trader. But in paper money, we have the opportunity to compare and contrast things. And so that's what we're doing here. So we reviewed a bunch of trades. We talked about what happens if you're assigned on the short strike on either a long call vertical or a short put vertical. We went through that in a fair amount of detail. You know, if it was prior to expiration, we placed 4 new trades today. And those 4 trades were on ARM and Intel. So ARM, ARM Holdings, and INTC. We did short put verticals and long call verticals. We'll be back on Monday. I want to thank Rachel for her help in the chat. I want to thank the guys behind the scenes for helping out as they always do. And each and every one of you for showing up, bringing energy to this class, being so participatory in the chat. I hope you found this to be a valuable conversation. Have a great weekend. Get out and hug someone you love and stay tuned. There's lots of great content still coming your way. Bye for now.